Hi, I'm David Vanlandingham. Welcome to another edition of Wealthy and Wise. We've got a great show today. There's lots of confusion out there about this one big, beautiful bill act, and we're going to try to clarify a lot of those things for you, the good, the bad, and the ugly. And no better person to join me, my partner of 14 years in crime of studying tax code and trying to decipher all these things so we can do a very efficient job for you and set up some planning and strategies. So, Adam, welcome to the show.
Thank you for having me. So yeah, I was really excited, David. When we try and stay out of politics because you may be on the right, may be on the left. It doesn't matter. We're all paying taxes. And there's a lot of things that have been done with the new administration to really spur economic growth. We got a $37 trillion deficit that our country has. And there's a couple philosophies to get out of this hole. And what seems to be working is to grow our way out of it and make sure that we have enough growth to cover all this debt we have and pay these bills. So back in 2018, they had the Tax Cuts and Jobs Act. And part of that was to reduce the corporate tax rates down to 21% for a C corporation, which is all the big businesses, Walmart, Home Depot, Lowe's, all those big companies operate as C corporations. Side note, they're all set up in Delaware. Delaware has the best laws for big business. If you haven't yet, check out our videos that we talk about the benefits of using Nevada and Wyoming for small business owners. But when this happened, they made these tax cuts for this corporations, the big companies. But what about the small business, which is the backbone of America? Well, what they did is they created some very lucrative incentives. Section 199A, Section 179. We're not going to get too technical on you, but Dave is going to talk about that. But they said, all right, we're going to lower the rates for everyday people. And it was temporary. So they cut, for example, the highest tax rate was 39.6%. They cut that down to 37. All these tax brackets dropped, but temporarily. And in my opinion, thank goodness that Trump got reelected because they made that permanent. And permanently, we have much lower federal tax rates, which saves households in general thousands of dollars in a year, depending on how much you make. Thousands of dollars a year in tax cuts that you get to take advantage of as a contributor of society. Well, one of the things they did is they said, all right, if you're a small business, which most small businesses operate either as a sole proprietor, a partnership, or an S corporation. And there's these huge tax benefits when you operate as an S corporation. People say, well, why do S corps get all these tax benefits? Well, plain and simple, our government tries to do things to encourage entrepreneurs, encourage investments in our great country to do what? Pay taxes. And one of the things that is amazing is that they made some very special incentives for small businesses to encourage people to start businesses and keep more of the money they make, and more importantly, to spend money. So, a lot of things that David and I are going to talk about is all of these great tax benefits that you get to spend money as a business owner and grow your business. So, again, the C Corp's got all these, permanent 21%. Then they came back in on the backside and they said, all right, for a small business, we're going to give you the QBI deduction. That's section 199A, which is Dave is going to talk about. They give us these 179 deductions where we get to write off the full cost of things right now to reduce your taxable income. So knowing why this has happened, again, our government is trying to spur economic growth. And to do that, so we can pay off this $37 trillion, they have made some incredible tax cuts that you, as a business owner or investor, can take advantage of. So, David, what do you got lined up for our schedule? What do you want to talk about, sir?
Let me piggyback on that for a second, what you just said, because a lot of people don't understand. So, whatever side of the political aisle you're on, it doesn't matter. There's always going to be people that scream to the top of the mountain, this isn't fair. The taxes are made for the rich. And I can tell you, they're not, right? We're going to talk about a lot of different types of deductions that get phased out after your income goes up to a certain amount. So these are this is for the backbone of America. That's what the small business is. And it truly is. So we'll start out. You talked about the 199A. We'll start there with the 199A deduction. So this is a qualified business income tax deduction. And what this allows you to do is basically eliminate paying taxes on 20% of your qualified business income. So if you made $200,000, that's $40,000, correct? So now you're not paying taxes on 40,000. And if you're in a, 22, 24% tax break, that's around between nine and $10,000 savings right there. But
Hang on. What do you have to do to get that deduction, David?
I was getting ready to tell you,
All right.
right? So it's who you are, right? So it's available sole proprietors, partnerships, LLCs, taxes, S corps, but not C corps, right? So there are people that get pushed out on this. And there's also financial phase outs as well. It's also not for anybody in the personal services industries, doctors, lawyers, CPAs, actuaries, brokers, professional athletes, people that perform on stage, right? So now we're really kind of broadening it out a little bit more. But it's just something that came in. There was talked about it was going to be phased out at some point. We hear this a lot every single year. You and I start studying around October for the next tax year, and we did that in 2024, got ready for 2025, and then boom, the one big beautiful bill act came along. We had to learn a bunch of new stuff again. So, but yeah, it's an incredible opportunity just not to pay taxes on that qualified income. And the biggest thing about it is it's a simple process, right? They're not making this complex. So it's not all these new things that they're doing. There's lots of complexity. There is to a certain degree, but once you're working with a professional that understands these things, it's actually pretty easy.
Well, I want to point out for everybody listening right now, whether you are a business owner or you're an investor or you're thinking about starting a business, I tell every single client that I work with, I say, listen, you need to start immediately doing a simple monthly expense report. It does not have to be fancy. Spiral notebook, Excel spreadsheet, QuickBooks, whatever you use, but you start doing a simple monthly expense report tracking your expenses. And the IRS rules are it needs to be monthly and you need to keep itemized receipts. So if you're starting a business, I always remind people at the top of the page, January expense report, four simple columns. So write this down: date, dollar amount, who you paid, and a brief description of what it was for. So date, dollar amount, who and what, and always keep itemized receipts and keep it organized monthly. What goes on the expense report is very simple. Number one, you're going to have your any cost that you have for your business. So I always start with the home office, which never do a home office. Uh, we want to make sure that you put administrative office in the home. You cannot do this if you're a sole proprietor. It needs to be an S corp to do this. But if you have a room that is exclusively used for business, that's your quote unquote home office. We calculate that square footage and say you got a room with a desk and a computer and there's a hallway that leads to a bathroom. Well, we get to track that square footage. If that works out to be 15% of the square footage of your home, your company owes you 15% of your monthly payment and 15% of utilities, electric, gas, water, and sewer. Start keeping receipts. Now, the home office is highly audited. Um, one of my clients is an IRS. I've got several clients that are IRS auditors, and boy, have I learned a lot. One of the things I learned is the top two red flags for audits. Number one, Schedule C. Number two, home office. They're both heavily abused. However, if you have an S corp or an LLC taxed as an S corp, now we can do administrative office in the home. So write that down: administrative office in the home. Now the company can reimburse you for the use of your administrative office in the home. You do not claim that as income. It does not report on the personal return. No red flags and no depreciation recapture. If you're a sole proprietor, you're doing a home office. Eventually, when you sell that house, whatever you wrote off has got to be paid back. Depreciation recapture. S corp or LLC taxed as an S corp, no depreciation recapture. Track your mileage. Get some business cards drawn up everywhere you go. You should be marketing your business. Have your business cards, and if you go to Walmart, as long as you leave a card with someone in the produce aisle or at least a cashier, purpose of that trip, marketing. and you never know where a new customer might come from. Meals, you go out to eat by yourself, can't write that off. Have breakfast, lunch, or dinner with anybody else, including date night. As long as we're talking business, keep those receipts. Always put your name, the name of the person or people you had the meal with at the top of the receipt, and the purpose for the meeting. Normally marketing. Your cell phone, cable TV or satellite, internet access. You got to buy a new desk, new computer, new phone. Anything that could possibly be a business expense goes on the expense report. And I'd rather you keep track of too much than not enough. It is the CPA's job to tell us if we're being too aggressive, we can always back it out. But this monthly expense report is for all the things that you pay for using your own cash and your own credit. So you can't commingle funds. I can't use my personal account to pay business bills or the business account to pay personal bills. It's commingling funds. Big no-no. However, if you're starting a business or you're operating and by doing that monthly expense report, that's what allows us to show lawyers or lawyers that might be suing us trying to pierce your corporate veil or the IRS. I am not commingling funds. Yep, I paid for all those things using my cash and my credit. The company's going to reimburse me when it's financially able to do so. So very important to do that. Now, David, talk about the special one big beautiful bill. We've got these special incentives like the 179, the 199A. What does that mean?
Yeah, so the 179, a lot of people call it the 179 vehicle deduction because that's what most people are thinking about, right? That's where you can buy a vehicle that's between, 6,000 and 14,000 gross weight pounds. You can get up to 31,300 as far as the deduction goes. So these are all incentives to go out and spend money, just like you said in your opening, right? We're putting people into a position where they can get incredible tax breaks for buying equipment, software, computers, all of these peripherals that businesses need, but they don't have to expense it off over time. And everything has a classification, or most things have a classification of depreciation periods. And what the 179 does is allows you to write off, $31,300 in a short period of time.
Hang on, so 1 second. Before the rule was if you bought a new car, for example,
Hmm.
and it cost you just for easy math, it cost you 50,000 bucks. I can't write the full $50,000 off immediately. I have to do a little bit this year and a little bit next year as a 5 year period,
That's
or you
right.
get to write off that $50,000 over 5 years. But what you're saying with the 179, I can take the full 50,000 the year I buy that vehicle and put it in service.
Yep. You can also combine this too with 168. So a lot of people get confused which way is better to go. And we're going to talk about that because the 179, although it's great because it goes up to 2.5 million that you can write off in qualified equipment, all the way up to 4 million is the phase out. So there's a lot of stuff in there that you can do. But when's the right timing? That's what it comes down to. And this is where tax planning and strategy comes in so we can take a look at what you're doing. Don't run out and buy anything until you talk to us because there may be a better way to do it, right? So the difference in the 179 and the 168 are huge because the 179, you can never create what's called a net operating loss, right? You can only go up to what the profitability of the company is. You can't go upside down. The one big beautiful bill pulled the sunset out of the 168, the 100% bonus depreciation. Right now, in the 2025 tax year, it was slated to be 40%, 2026, 20%, 2027, it was going to be gone, bonus depreciation. So, what they've done is they've brought it back 100% bonus depreciation and made it permanent. So these are some of the things that we're talking about that, just between administrations, things go back and forth, things sunset. Well, now it's going to be permanent. And the big business, the One Big Beautiful Bill Act is the perfect fit for this because now you can go net operating losses. So if you have a lot of expenses and they exceed the income, now those losses are going to reduce your tax basis. So it's the perfect tool for where we're at in today's economy and what we need to do. We need to exactly what you said. We need to spawn some growth in companies. We got to spend some money, but also we need to be somewhat rewarded on the income side of it, and that's what it allows us to do. So, if I want to go out and buy a $100,000 truck for my business, I can decide strategically, do I want to take 100% the first year because I had a really big year? Or maybe I'm just kind of getting started and I don't want to take the whole thing. I can, chop it up in little pieces at my discretion, not based on a 5-year rule, which was standard depreciation, which you were talking about earlier. So this gives us the opportunity to plan for these things and take a peek where we're at in our business and forecast where we're going to be. Where are these, big deductions going to be, better off for us, and how are they going to work? So 100% bonus depreciation here to stay. Thank God. Everybody's excited about it. So it's a great thing for small business for sure.
Well,
So
and you said something that was really important, that in terms of tax planning and tax strategies. So all the time, I have a really good friend that is a mortgage broker, and he does a lot of loans. You'll find that the wealthiest people in the country, they invest in real estate. So if you have a small business, yeah, you don't have to be a property manager. There's companies out there that you can hire that will charge you, 10%. They manage your property and you own the property. And over time, it's the most wonderful thing about a renter. They won't buy themselves a house, but they'll buy you one.
that's
So
right.
the renter comes in, moves in, and through inflation over time, property values go up and your tenant pays down that mortgage. And that's how you build wealth. One of the greatest generational wealth tools we have is the step up in basis. A house that you bought today for $150,000, 20 years from now, you die, that property is now worth $1 million. Your kids can inherit that and not pay a dime in taxes. And we'll come back to the exemption amount, because there is a point where your estate's so big, you're gonna pay the government 40% on anything above 30 million. We'll come back to that. But as we buy this real estate, automatically happens. You don't do anything special. You get to write off the mortgage interest, property taxes, insurance, any improvements that you get, or repairs and maintenance. You get to write these things off against the rental income that you receive. Well, as a real estate investor, and again, we have another class or another episode where we talk about the keeping active income and passive income separate. Um, but buying these properties is a really big deal. So you take your money that you've made personally and you buy the rental. Well, the problem is, as a business owner, when you're an S corp or even a sole proprietor, you're trying to make your net profit as small as possible so that you pay the least amount in taxes possible. Oh, the problem? Yeah, go ahead and zero out those taxes. When you go to get a mortgage, what do you think the mortgage guy wants to see? What do the banks want to see? They want to see income. They want to see that you have enough income to cover that mortgage, so that they're not giving out these, liar loans where people don't have the money to cover it, and 2008 starts all over again. So there's this delicate balance where when you talk with your CPA, you want to make sure that they understand, if you're trying to show enough income to qualify for certain loans, then you got to make sure that you have that conversation with your CPA. Yep, all these things we can write off, like you're just talking about. That new truck purchase for 100 grand, yeah, I can zero out my taxes doing that, or potentially zero it out. But I go to buy a new house or buy a rental property. Oftentimes they look at these things and they go, oh, you don't make enough money, your debt to income ratio's off, and we're not going to give you the loan. So that's very important. You have that conversation with your CPA to make sure you don't put yourself in that bad position. If you've already done that, don't forget, we can do amendments. We can go backward up to 3 years, amend those tax returns to make sure that you're not putting yourself in a bad position for obtaining loans.
Yep. And this is all strategy, right? So you and I were talking earlier. So let's talk about tax on tips and tax on overtime, because there's the good and the bad, right? There's always two sides of this, and this is where strategies come into play. So let's talk about the tax on tips first, and then we'll talk about the overtime.
Yeah. So if you are you make tips for a job, there was this, a big push for no tax on tips. Sounds great. And I agree with it 100%. But what actually happened was that the bill says that you don't have to pay tax on your first $25,000 of tips, which I think, unless you're a server at some high-end restaurant, is probably going to cover you. But what happens is, yep, you claim it and you pay taxes on it, but when you file your return, you get to reduce your taxable income. If you made $50,000 and you are, I had $25,000 of tips. When I file my return, that $25,000 gets reduced. Instead of me paying tax on 50 grand, I'm only paying taxes on 25,000. Same thing with Social Security. If you receive Social Security income, they allow you to deduct a certain amount of that income. Not all of it, but a certain amount of it you can deduct. And every situation is different. So don't immediately think, well, David and Adam said that I don't have to pay this. Every situation is unique and different. So again, these are things you got to talk to your CPA, your tax professional to make sure that you have a clear understanding. Don't go into thinking that you're not having to do this or not have to do that because that, you know, how it sounds on one end and what really happens are two different things. By the time Congress got done with the no tax on tips, that's what they came up with.
Well, and the overtime is basically the same, right? So what happens is, and this ties right back into what you just said, you take that 25,000, now your income's only 25,000, you want to go out and buy a new car. Do you even qualify, right? So with the overtime, make $10, $20 an hour, whatever, get that overtime. We're only writing off that amount that's overtime, dollar wise. But that's going to directly affect your income level too. So, you have to think where you're at in life and do I really want to do this, right? And it may depend where you live too. Live in a place like Nevada or Florida or any other state where there's no state income tax, there's a little bit more relief there because now you're not paying at the federal and state level. So it's all strategy, Adam, 100%.
Yes.
And I heard some things are going away, right? Something with the EV credit, I think it was, right?
Oh yeah. So the EV credit, you got a nice tax credit when you bought an EV vehicle. Well, that goes away September 30th of 2025. You better have bought that vehicle. If you're a business, you better have bought it and put it in service by September 30th of 2025. Um, if you have a rental property, there's another credit where you get, or even a homeowner, you get a credit for buying solar.
Mhm.
It's 30%. If you spent, $20,000 on solar to put up some new solar strips or whatever they call it, you get a tax credit of 30% of what you spent. So that's a tax credit. Don't forget, a credit is comes right off. If you owe the IRS 10 grand and you got a $7,000 EV credit, you don't owe them as 10 grand. You owe them 3 grand. It's a tax credit, dollar for dollar, versus a deduction just reduces your taxable income. So these are huge. So if you have a rental property or a primary residence and you've been thinking about putting up solar, you better get that done before January 1st. So again, for real estate investors and homeowners that are thinking about doing solar, these things are phasing out.
Yeah, they are. And that's, this is again the good, the bad, and the ugly, right? There's got to be give and take somewhere. It just can't be all, roses and daisies. At some point, there's got to be a little manure that keeps that stuff growing. So you mentioned earlier about the estate tax. Let's talk a little bit about that because I know there's some changes. Again, these are things that they said, oh, let's just eliminate this, eliminate that. And for people that have, families that have extended wealth or wealth themselves, can impact generations to come. So let's talk about that.
Yeah. So when I first started in this business, it was back in January of 2001. And if your estate was valued at above, I think it was like 684 or $686,000, everything above your estate value above that $680,000, your family had 9 months to come up with taxes of it was 40% for anything above your 684,000. 40%. Well,
And
over time,
that's business and personal assets, correct?
oh yeah, whatever your value is worth, life insurance, you add it all in, and boom. Well, over time, they've raised that up through inflation. And in 2010, my grandfather died. He had a $10 million estate, and that was the only year that they had no inheritance tax. So he picked a great year to die. He ain't paid taxes, and glad he died. That he died, but he picked a good year because no inheritance tax. The year after that, it went to $5 million. So anything above, if you're married, it goes 10 million. But anything above $5 million, you'd be paying, your family would pay these taxes. And I'll tell you right now, with crypto and real estate and these economic booms that we've had, this is huge. And you see a lot of family wealth destroyed by inheritance tax. Well, part of the one big, beautiful tax bill, they made that we thought it was going to drop back down like to like $7 million, which could be devastating. It was 14 if you're married. They raised it up to 15 million if you're married, 30 million that you can pass on to your family without any inheritance tax. Now, keep in mind, there are most states mirror that, but states like Oregon, I can't remember the dollar amount, but I think Oregon is a small amount, a couple $1 million. That if you're above that, your family's going to pay Oregon an inheritance tax, and I think it was like 10% or uh, that they have to pay on the net or the gross value of your estate. That in life insurance, all of that. So there's little strategic things that we do. You got to start thinking about if you have a big life insurance policy, think about getting an irrevocable life insurance trust to remove the value of your life insurance outside your taxable estate. But 30 million covers a lot of people. I have very few clients that are above that 30 million mark. Um, but that's a big one.
Yeah, it definitely is. So right now it's 13.99 million, and then it jumps to 15 million, 30 million if you're married. So that's amazing. What are we doing? We're not penalizing people for being successful, right? We're raising that bar, that level, and creating generational wealth, which is awesome. So I know you wanted to talk about the 1202 because you actually had a client that you were able to help out with this and the sale of a business. So let's dive into that a little bit.
Yeah, so 1202 is a section of the tax code that if you are a C corporation and you are starting a business, we've got some rules because when you start that company, if we get this set up right, when you sell that business, as long as there's certain rules for it, but you can sell the business and pay no tax on the sale of that business. Um, it is huge. So as a small business owner, an entrepreneur, you can start the business, grow it, and then sell it and not have to pay a dime in tax. And it's $10 million that you can sell that business for and pay no tax. That's the section 1202. The problem is you have to be a C Corp or an LLC taxed as a C Corp. And the tax election must be made within 30 days of issuing that stock. So a lot of venture capital firms and other people, they like to invest in businesses that are C corporations, but they have to make a special tax election when we set it up, when we issue stock. We've got to have that set up and in place. There's a vesting schedule, some other things get kind of complex, but there's a give and a take because we were talking earlier about the section 199A, where you get this beautiful 20% reduction. You have to pay tax on 20% of your income if you're an S corp, partnership, or sole proprietor. Guess what does not get that section 199A? The C corporation. So with that in mind, again, we got to think very strategically. There's a give and take in everything. And I guess what are your thoughts on it, David?
Yeah, I mean, you just kind of weigh it out, right? I mean, so we talked about 21% tax rate levied on the C corporations, plus, you're taxed again on distributions. So that's the double taxation everybody talks about. So, this is all strategy. So if I'm starting a business and really we're not selling the business, we're selling the stock of the business. So, do I take this and get it set up that way as an option? Because you never know, might get out of the business, 3, 4, 5, 10 years later, whatever. And I have to know what that exit strategy looks like and how can I do it. Otherwise, that's going to be a really big tax bill. So you have to consider the lack of getting the 199A deduction on the C corporation. You have to consider the 21% in tax plus the double taxation of distributions and really feel out, which way is this going to go? What's it going to be better? Because you can't start out as an S and then change it, to a C later on. You can't do it. So these strategies come in ahead of time. And that's why we urge our clients before you do something, before you buy a property, before you buy a business or sell a business, reach out to us, have a call with us, let us look at it, give it a 30,000 foot view, and then dive in special areas where we need to, because there may be some other things that we can do as well. So it can be complex. We try to make things simple, but in reality, at times, it's one of the most complicated things you'll ever do is tax strategy. So anything else on the one big beautiful bill?
Yeah, I guess one last thing is the issuing K1. So if you're a business owner and anybody that you pay $600 or more to, we had to send them a 1099. So we always tell people if you're paying anybody for anything, 600 bucks or more, if you hired a contractor or anybody to work for your company, you pay them 600 bucks or more, you got to issue them a 1099. So we always tell people when you hire someone, you always make sure that you get a W-9 that has their information so you can issue the 1099. And there's like 27 different, 28 different 1099s that go out. But something that they did that was good is that they changed it to not 600 bucks, 2,000 bucks. So anybody you pay $2,000 or more, we still got to do 1099s, but 2,000 or more, and that's really big for small business owners because sending these things out come January 1st, we got until the end of January to send out our 1099s to anybody that we paid 600 bucks or more to as a small business owner. Well, now it's 2000 and that's going to adjust for inflation. So that'll go up a little bit every year. Right now it's 2 grand, maybe next year is 2150. They always adjust these things for inflation, but that hasn't been looked at for I don't know how long. It feels like since 1950 they've had that rule. They
Yep,
finally set it to adjust for inflation, but uh, you have to get those W-9s so that you can issue 1099s appropriately. And it always seems like, you know, your CPA says, hey, where's the 1099s or where's your W-9s? So we can issue the 1099. And now you try and call those people that you paid, and they're thinking, oh, shoot, they didn't ask me for a W-9. I don't have to claim this income.
exactly.
Even if you don't get a 1099, you better claim it because it will catch up with you. And God forbid you do get audited and you haven't issued them properly or claimed them properly, you're going to have a bunch of penalties and taxes. So you got to make sure you do that right. But that was, I guess, the last thing that was really a lot of other things that they've done as well with research and development credits that you get. Uh, a bunch of the opportunity zones. They now have something I learned today was the rural, so qualified opportunity zone where you can invest in certain areas. As long as you hold that property for a certain period of time, that you can sell the property and that you get a step up in basis on rental properties that you buy if you've held them for 10 years and invested in these qualified opportunity zones. Well, now they also have a rural opportunity zone. And it's a bunch of cool things that they do to encourage people to invest in real estate and small businesses. So a lot of things that our government does to try and encourage, like I said, we got to attack that $37 trillion debt and we're going to grow our way out of it is the plan right now. That could change. Administrations are different, but right now, as a small business owner, as an investor, you got to have these talks with your CPA, and you should always have these talks. As a W-2 employee, there's not much I can do. I can put money into an IRA, I can have more kids, I can buy my own house, little things that we can write off. But when you own a business, there are so many tax planning opportunities, so you got to get in the mode as a business owner. Tax planning is an all the time thing. You should absolutely be doing quarterly calls with your CPA um, to review what happened last quarter. Am I doing things right? And the drop dead date is come the end of October, early November. You need to be talking with your CPA or tax professional about the tax planning. What I found, a lot of CPAs, they just prepare and file an accurate return based on the information that you provide. Well, NCH with our partners, we do tax strategies and tax planning so that we can help you to legally, strategically reduce that tax bill. So make sure if you have a good CPA, great. If you need a good CPA that can help you strategize, please reach out to NCH, schedule an appointment with one of our professionals, and let us review what you're doing and how you're doing it. And again, if we see mistakes all the time. So a few months ago, I had a guy that his CPA did not do things right. And I remember one of our CPAs, he did a review, and in 20 minutes, he called me and said, Adam, I just found $40,000 that this client overpaid in taxes. That was in 20 minutes. You think working with a professional is expensive? go hire an amateur. That inexpensive return he got done cost him $40,000 from not working with an expert and not working with a professional. So that's
Here's
all
the
I
crazy
got for you today, David.
here's the crazy thing. He didn't even know he was missing that 40,000. He just assumed, you know what? That's what they said. Write a check, right? Amazing stuff, Adam. It's always a pleasure to have you on this, and I'm telling you, we're in an ever-changing time right now with tax codes and incentives and everything across the board. So this is for small business owners. This is a great time to be where you're at for sure. So, Adam Kintigh, thank you. Appreciate you being here. For those of you out there, please like, share, and subscribe to keep coming back because the more you come back, the more wealthy and wise you'll be. David Vanlandingham signing out.